Have we moved past enough trade obstacles to see a resumption of growth? It doesn't sound like you think so.
So we've definitely been in a global mini-recession, and U.S. manufacturing has been in a recession. The U.S. economy has been okay overall, and the central bank is easing. There's no inflation really around the world, and that allows central banks around the world to keep easing. And you have balance sheet expansion along with lower interest rates. And you can tell if it's working by the extent to which stock prices go up. So today is a big day because the market's making upside breakouts, and that means that the monetary stimulus is working through the system, and we should see a bottoming in the slowdown in growth sometime in the next few months.
Really? So you think Q4 might be the bottom, or Q3? And what is the bottom in terms of U.S. GDP?
The bottom, don't pin me down on a date.
Okay.
But the bottom, that's probably about right. And growth it will bottom at about 2% for the U.S. You already see some improvement in housing, but the thing that's not being thought of right now with you and me is that house prices are doing better. So to the extent stock prices do better, house prices do better. And last week they reported that existing house prices were up almost 1% month to month in September and 6% year on year. So yeah, both stock prices and house prices doing better, and that lifts consumer net worth, which helps the economy with about a 2-quarter lag.
Ed, this idea of a bottoming, I wonder how much of it hinges on trade dynamics, and not just U.S., China, and seeing that maybe take a pause and not ratchet up, but also USMCA getting through Congress and everything we're seeing play out with Brexit.
So, it definitely plays a role in it. We've been at this now for 11 years, and I keep looking at the economic fundamentals, and the backdrop keeps changing on the geopolitical. Like in 2012, you had Europe go into recession, Greece almost went bust. And now you come forward and you have the problems with the trade and Brexit. And so those are a constant backdrop, and they're one of the reasons that central banks have been easier. But at the moment, it looks like the path of least resistance is for asset prices to go up, and that pushes ahead economic growth and sort of moves through those. Now, Trump has an agenda that he's watching for the election, and he needs to get some of these things bedded down if he wants to get reelected. And so you're getting some progress on trade in that regard.
Well, Ed, what happens if Powell says, given all of that, we're going to give you your October cut and that's all? What if the 10-year goes back to 2 instead of 1.5?
Well, I would like it if the 2 would go back to, if the 10-year would go back to 2. It's now 1.85. And our best guess is that Powell will not give a particularly dovish interpretation this week when they cut rates, as you're pointing out, or a particularly hawkish one. He's going to thread it in the middle there, leave options open to stop easing if he needs to. And as we all know, this will be the 3rd rate cut, and that's been sort of the magic sauce in the 90s to get growth to stop slowing. For example, in 95, they cut rates 3 times, economy stabilized. They did it again in 98, economy stabilized. So they feel like they're in sort of familiar territory if this works out. And the stock market rallying is a suggestion that it is working out. And of course, with the economy doing okay, earnings are coming in okay. They're not strong, but they're enough to keep things moving ahead.
Right. It sounds like you think people have said policy easing is losing its effectiveness. You look at what rates are doing. Look at the number of dissenters we're getting on the ECB. Rosengren and George may dissent this week. Doesn't sound like you think that argument is necessarily wrong.
So my base case is that the extent to which monetary policy works is the extent to which it pushes up asset prices, both stock prices and house prices. And we've already discussed that just now, and they're both doing better. So I think the Fed is, they have to be, pretty happy with what they're doing. And I don't think you have inflation yet, so the Fed can, be relaxed. And if they are too slow in tightening, if they're too slow in stopping they can always go in and make up for it. If they shouldn't cut, then they can go in and reverse that. But at the moment, I think they're in a pretty good position, given all the circumstances.
Ed, 2019 is shaping up to be another year where it's been this value versus growth debate in the equity markets. I wonder where you fall in that debate and how you think it sets us up for 2020.
So, Morgan, I don't fall in that debate. It's not in my wheelhouse, really. And so let's move on to another topic. But
sure.
My main feeling is that monetary policy is working and the U.S. economy is okay and there's not much inflation. I would like to mention, guys, if I could, that the market still is climbing a wall of worry. Barron's had over the weekend a survey they do, and there were 27% of the people were bullish, and that was the lowest in over 20 years.
Oh, finally, Ed, one last topic, I guess, one that makes sense is hopping from all the things we've discussed, macro and trade, to politics. How much of an anchor do you think that's going to be, either because they're fretting about Warren or just general election angst in 2020?
It's a big anchor. And I think some of the developments over the weekend in the Middle East might put Warren at a slight disadvantage from where she was. But during the year, the market's going to trade a lot off of whether or not it thinks that Warren might win and the economic implications for asset prices in that regard. So it'll be something that we'll be talking about all year.